All right, let's dive into the psychology of the market. We're going to be drawing on some amazing insights from trader Gerald Ashley to pull back the curtain on the whole financial world. And we're going to see why the single biggest risk to your money might actually be your own brain. Let's get right into it. So, let me start by asking you a question. When you put your hard-earned money into the market, what are you actually doing? Are you investing? Are you speculating? Or are you just playing gambling? The financial industry really wants you to feel good about one of those words. But as you'll see, the lines between them are way blurrier than they want you to believe. So here's how the game is sold to us. On the one hand, you've got the marketing pitch. Investing sounds prudent, cautious, safe. It's what responsible people do, right? But the word they try to avoid, speculation, well, that's often much closer to the truth. That word makes you think of wild, unregulated markets and ruthless risk takers. But here's the thing, is that distinction even real? And that brings us to our first huge point, the market's dirty little secret. See, the industry has a massive financial incentive to make you believe that investing and speculating are totally different things. But they're not. Not really. You know, the brilliant economist John Maynard Keynes, who, by the way, was an incredibly successful speculator himself, he absolutely nailed this decades ago. He said speculation is just forecasting the psychology of the market. And that's the key. When you buy a stock hoping it'll go up, you're not just betting on the company itself. You're betting that other people will think it's worth more in the future. And that, my friends, is speculation. Okay, let's move on to our second big myth, because it builds right on top of this. It's the illusion of complexity. The financial world just loves to make you feel like you need a PhD to have any clue what's going on. But that is just not true. In reality, every single financial product out there, I don't care how fancy or complicated it sounds, from a basic stock to some crazy derivative, it can all be broken down into these three simple ideas. Are you buying or selling something? Are you borrowing or lending? And are you doing it right now or sometime in the future? That's it. That is the whole game. So why all the confusing jargon? Why the complex math? It's not because the ideas are that difficult. It's because complexity is the perfect place to hide fees and profit margins. When you're confused, they're making money. Always remember, the underlying game is surprisingly simple. So if the mechanics are simple, what's the hard part? Well, it's right here, trying to forecast market psychology. Because markets aren't just driven by cold, hard logic. Nope. They're driven by human emotions, fear, greed, you name it. And I can't think of a better example of this than the ridiculous Palm Pilot bubble. Okay, picture this. The year is 2000. It is the absolute screaming peak of the dot-com mania. The giant company 3M decides to spin off its super hot subsidiary, Palm. You know, the company that made those cool little Palm Pilot devices. But here's the catch. They only put a tiny slice of the company on the market, just 6% of all the shares. What happened next was just pure madness. On the very first day of trading, that tiny 6% stake exploded so much that the market valued Palm Inc. at 54 times billion dollars. Now get this, that made Palm worth more than its own parent company, 3M, the same 3M that still owned the other 94% of Palm. The market was literally saying a small slice was worth more than the entire pie. It was completely irrational. So what on earth was driving this? It's a classic case of the greater fool's theory. People weren't buying Palm stock because they thought it was actually worth $54 billion. No way. They were buying it because they believed they could flip it to someone else, a greater fool, for an even crazier price tomorrow. It's a high-stakes game of musical chairs, and it's driven entirely by psychology. This belief that we can somehow outsmart the crowd, that we can predict the psychology, well, it feeds directly into our next myth, the idea of the all-knowing market guru and the entire prediction industry that's built around them. Ever wonder how someone creates the illusion of being a market genius? It's disturbingly simple. You start with a big list, say 10,000 potential clients. You tell half of them that a certain stock is going to go up, and you tell the other half it's going to go down. A month later, one of those groups was right. So you just throw away the list of people you were wrong about, and you do it again with the remaining 5,000. You keep doing this, and after just 6 months, you're left with about 150 people who have seen you make 6 perfect predictions in a row. To them, you look like a prophet. In reality, it's just a numbers game. So if we can't trust the gurus, what should we really be worried about? Well, it's usually not the big, dramatic market crash you see on the news. The real danger, the real threat, comes from the hidden killers, those slow, silent things that drain your capital over time. These are the enemies that fly under the radar. You've got the obvious ones, right? Brokerage fees, the spread between the buy and sell price, slippage on your trades. Each one is like a tiny little paper cut that over time can cause you to bleed out. But then you have the psychological enemies, which are even more dangerous. That little voice in your head, the sunk cost bias, telling you to just hold on to a losing trade and hope it comes back. And then there's the most misunderstood killer of them all, the brutal, unforgiving math of loss. This is what I mean by the asymmetry of loss. And this math is absolutely unforgiving. Let's say your investment drops by 20%. You might think, okay, I just need a 20% gain to get back to even. But that's wrong, because you're starting from a smaller base now. You actually need a 25% gain just to get back to where you started. And the deeper you fall, the steeper that climb back up gets. This is why protecting your capital is so much more important than chasing some huge return. It's a painful reality that trips up so many people. So, after busting all these myths, what's left? What is the real path to success? What's the one thing that truly, truly matters in the financial markets? Well, the legendary trader Jesse Livermore said it best, like 100 years ago. The technology changes, the products change, the players definitely change, but the game itself stays the same. And why is that? It's because the game was never about algorithms or secret formulas. It's about human nature. Fear, greed, hope, panic. These things are hardwired into all of us, and that's what really moves the market. And that brings us to the final and most important takeaway. It's easy to feel like the market is personally out to get you, but here's the truth. The market doesn't even know you exist. It doesn't care about your position. It doesn't care about your hopes or your fears. The only person who cares is you. So the ultimate challenge isn't trying to outsmart the market. It's about understanding and mastering yourself. Do you have a plan? Do you have the discipline to stick to it? Because in the end, that is the only thing you can actually control.